Welcome back to New Money. This evening we're discussing investments. My guests David Shapiro and Craig Pfeiffer. If you'd like to email, you can send your query to info@anchorcapital.co.za. Before I get on to the emails, Dave, one of the areas in all the portfolios in 2023 that underperformed was any exposure to China. Now, China is a big economy. How are you feeling about China as a recovery stock?
Maybe on the consumption side. We're hoping that they can get back to the kind of high growth areas. I still think they're battling on the property front. I don't think Xi Jinping has they're trying very hard to stimulate the economy. It's taking a little time. I think investors are still very skeptical about the pressure that they put on the IT sector and the authoritarian approach that they do have to business. So even though they're trying very hard to get China going again, there's a lot of skepticism out there. I think, very simply, I would play it by investing in Western companies, if I can use that expression, that are still doing business in China, rather than going direct to China. So I prefer people who are selling their products. It could be on the luxury side, it could be on the motor vehicle side, it could be on the consumption side, like a Nike or something like that. If you wanted to pay, that's not a recommendation. But I'd rather play it that way than go into China.
Because for years we saw Japan in the doldrum, and all of a sudden over the last number of years, Japan market reaching new highs, and that's where a lot of growth has come from.
I think China's probably in better shape, because it was the property market that took Japan down as well. You remember they had these zombie companies that they just kept maintaining. I don't think China is like that. Craig might have a better view, and I'd like to share his view on this, but I'm still skeptical. I still remain.
Okay, let's go to Craig. Craig?
Well, I think the markets are all, you talk to analysts and say the country itself, the economy is too large to ignore. You can't ignore it, but at the moment, we're still a little skeptical. We've got our fingers burnt in a lot of companies. I think Evergrande's going to be liquidated kind of this week or something. So there still are issues around needing to support the property sector.
Well, that's not a stock that was in your portfolio.
It was not a stock.
I'm just saying, it was not a stock in your portfolio. Great, so let's talk about interest rates being so high. So someone who's tax neutral and is getting, I looked at government retail bonds for December. They certainly have come down. People must realise that the long-term interest rates are down. Government 5-year retail bond was at around about 11.5, 11.75. This morning for the month of December, it's 10.75. So you've certainly seen those longer-term rates. But someone who's neutral, and you can get, tax neutral, in other words, doesn't have a tax problem, getting 10.75 over a 5-year?
Well, it's quite a benchmark to beat, I think, consistently, in equities. I still think equities are the place to be over the longer term. And these interest rate sensitive instruments, be they deposits or whatever, those rates will come down as interest rates come down. And interest rates coming down is good for equities. And really that is where you want to be over the longer term, because that also gives you a hedge against inflation. And not paying tax on your interest is one thing, but you still have the erosion of inflation eating into
that's what I always say to investors. You've got to look at the net rate.
Yeah.
Don't look at your gross rate. If your gross rate's equal to your net rate, you're not paying tax. It's one thing. But if your gross rate sounds high and you're getting 5.5, you're not going to beat inflation.
Yeah.
So then let's just talk about government bonds, Craig. We've seen government bonds get to a high in September, October, and in the month of November, we've seen our 10-year bond below 10%. Can you see these rates even coming down further?
I think they will come down further, but the markets, the bond markets, all markets, even the equity market, starts anticipating things before they happen. So we're starting to factor in, and even the US Treasury markets had a heck of a move over the last 2 weeks, rates coming down, anticipating that we will see the next move from the Fed. Locally, the next move will be for the SARB to cut interest rates. It's just now is the question of when. So that's what we're speculating on now. I think the Fed or the US market's factoring in about 100 basis points cut there over the course of next year, maybe starting before, just maybe in the second quarter somewhere, even early in the second quarter. Locally, also expecting something like 100 basis points cut next year, maybe also starting somewhere around mid-year, sort of around the May meeting or so. So interest rates are definitely coming down. The market started to build that expectation in, but I think it's still got some way to go.
I think what people don't understand is that when you do start lowering interest rates, it means consumers get more money in their pockets. Whether they're paying for a motor car, whether they're paying on their mortgage bonds, whatever it is, it does give them that additional money. So there is that gearing effect that you get in an economy. So while the markets respond to it, the real economy also responds in a very big way. So I think we tend to underrate what lowering interest rates really means for people, because there's a huge amount of borrowing in whatever form. Businesses borrow, individuals borrow, and that. When they start, we've seen the opposite happening. Now this is a reverse. When people get more money in their pocket, they tend to go out and spend and really give the underlying economy a kick. And that's why it's so important for us to start to see rates come down.
And that's evidenced by the pension fund two-pot system, which is going to implement on the 1st of March 2024, and that's going to allow people who are working, only people who contribute to pension and provident funds are working individuals, so they can put bread on the table. It's not the people who are unemployed. They're going to be able to borrow from their funds at a certain rate, up to 30,000. I'm not going to get involved in the. When I do retirement planning, I'll get involved in giving more detail to our viewers of what that two-pot system means. And then David, before we get into the email, just one question. The rand seems to be all over the place, because you've seen the rand, you've seen the pound strengthen in the month of November by about 3.5% to 4%, and you've seen the rand weaken, and then you've seen the rand strengthen, and then you've seen the rand weaken. The rand's all over the place.
Totally, and it's hard to explain. I don't think anybody has got a grip on what's happening on the rand. It could be that the issues within this economy are now starting to hurt. In other words, I always say that our economy is taking a lot of body blows, and maybe foreigners or people who would normally buy the rand or look at the rand are now starting to take notice. We can't ignore Transnet. We can't ignore Eskom. Even at this stage, whether it's 4 or 5, whatever we are in, stage 4 or stage 5, it does affect the economy. And that might be one of the reasons that we're seeing. Because up to now, the rand has actually overcome that. It hasn't really been swayed by that, but this might be a reflection on that. It's very, very difficult to read the rand, but we are in weak territory.
Dave, you off tomorrow? Have you bought your currency?
Yeah. It happens every time I go. And I think when you really want to know how, I always say, if we're feeling poor, the reason is we are poor. And if there's anything that identifies it, it's when you go into New York, or where I'm going to see my grandchildren and that, and you have to buy a meal or buy a ticket for anything. It's.
Let's get to emails. David Justin from Randburg says, you've been in the market for over 50 years. What would you like to impart a few key things that you've learnt over this period that can help investors? Do you remember?
I can't remember 50 years. We were talking earlier about Munger and Buffett. And I think their philosophy, it's only, when you've been in the market, do you realize how simple it can be. Very simple. And the simplicity is actually finding good companies. Now, it's not difficult to understand what a good company is.
Although a good company doesn't always make a good share.
Maybe not, but that's where you have to do your reading. But if you stay with good businesses, that are still making profits, that are applying back some of the profits into reinforcing or rebuilding their brand or maintaining their brand. In fact, if you don't know what a good company is, ask your grandchildren. They'll tell you what a good company is. They'll tell you where they're buying, where they're spending. But I think, and stay the course. That's the problem. We tend to get too emotional in and out and so on. And the best thing is just to find the good businesses. Don't think they're always going to be business. Just stay the course.
Well, I got an email here from Eugene in Hillcrest. Says, I find that investing is emotionally taxing, even though I'm a long-term investor. When I see the volatility in the value of my portfolio, I cannot say it does not affect me. What would you suggest? Craig, what would you suggest on the emotion?
Part of our job as asset managers and talking to clients is to be psychologists, and for this very reason. And if you look at the market, we were down August, September, October, and in the US, November, we made up all of those losses. So I can appreciate the volatility does does impact people who look at it on a sort of minute to minute or day to day, or they've got too much time on their hands. But my philosophy is exactly the same as David's. Buy good shares and keep them. You monitor, because sometimes things do go awry, even with the best companies. But just don't look at it minute to minute.
Bryan, I've done something brilliant. So when I look at my screen, I've changed the red to yellow. Okay, so I never see green. I never see red on my screen. I see either green or yellow.
Yeah,
and it's surprising when you.
Are you feeling better?
I feel much better.
Because David, we say to our customers, don't look at the portfolio. Yet we're watching it minute by minute. It's terrible because we feel the same. People mustn't think we don't feel the same way when portfolio's down. We don't like it.
And the best, Bryan, is that you can buy a client 20 shares, and 17 can be doing brilliantly. And there'll be 3, I call them yellow now, on the 3 yellow margins. And that's what the conversation will be, the ones that flop. You say, but why don't you look at some of the others? Dave,
I'd love to continue, but we've got to. It's quite amazing after the good run-up in 2021, the downturn in 2022, and despite the many forecasters that predicted a dire year for the world equity markets in 2023, the markets have performed so well. Most of the losses were made up. Historically, financial markets have always had the ability to rebound from economic downturns. Markets do not just go up, there are always periods that they go down. However, over the many years, they've typically followed periods of recovery and growth staying. Stay with your investments. Don't anticipate what the bad news and the headlines you see, and I can assure you, when economics will rebound and your portfolios will be upside. David? Craig, thank you for joining me.
Brian.
I'd like to thank our viewers for watching tonight. It's important to note that our program is to provide information and should not be construed as advice. Next week's program, we'll be dealing with financial and retirement planning, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.